Okay. Welcome to Building Your Wealth Destiny with Notes with me. I'm your host, Monique Hom. I'm here with the incredible Paige Panzarello. I'm super excited to have you all here with us tonight. So just a little bit about me. I am the founder of Real Estate Investor Goddesses. My mission is to help 1 million women create financial freedom through real estate investing. I think Notes is a wonderful way to do that. So I'm super excited you're here to learn more about that. I am a real estate investor and a syndicator. I've been in this business for 17 years, had over 1,000 sold in, I think right about now, we're right around 1,000 doors, residential, commercial, across 15 states. I'm the #1 best-selling author of Invest Like the Real Estate Investor Goddess Handbook and Invest Like a Goddess. I'm the host of Real Estate Investor Goddesses podcast, and I'm a real estate educator, mentor, coach, and I'm super excited to have with us tonight Paige Panzarello, otherwise known as the Cash Flow Chick. She's a real estate investor and entrepreneur with over 27 years of experience. She currently focuses on non-performing notes that she purchases across the United States. And if you don't know what non-performing notes are yet, you will for sure by the end of this webinar. She teaches a workshop that that shows how to buy non-performing notes, what to look for, due diligence to perform, and how to mitigate risk. Taken this workshop, and it's an incredible workshop. Having experienced the crash of 2007 and what she calls a very difficult learning experience, she knows firsthand how life can happen and how to overcome. So her company was founded to help people in distress, people first, profit second. I'm super excited to have her here to share with us tonight. So welcome, Paige.
Oh, Monique, thank you so much for having me. I just love participating with you and the goddesses. As you know, I love your organization. I love your women and I love your mission. So thank you for having me.
Thanks for being here. And I know you have a lot to share. So go ahead and share your screen and let's find out more about non-performing notes. It's a very lucrative way of investing in real estate.
Absolutely. All right, let's do this. And everybody bear with me because sometimes technology is not my friend. All right, I think everybody can see my screen. Yes, everything's good there. Excellent. All right. So as Monique said, I am Paige Panzarello. I am the Cash Flow Chick, and I have been doing this for a very long time. I've been in real estate and real estate investing for, as she said, over 27 years. Real estate is not something that I chose. Real estate is something that chose me. I had a grandmother that passed away. She had a very large estate. And it was severely in debt. It was about $4 million in debt. We had California properties and properties in Arizona. So in my 20s, off I went to Arizona to handle the Arizona properties. We had a sewer treatment plant. We had 38 townhome units, and we had some land. And long story short, I really knew nothing at all about real estate and real estate investing. And there weren't really the platforms that we have like we have today. There were no podcasts, there were no webinars, there was barely the internet at that point. So I really had to be bold and ask questions from the people that had the answers that I was seeking. So fast forward a little bit, I dove headfirst right in. I was bold, I was fearless, I was young, I had nothing to lose. And I ended up being quite successful in figuring out, wow, I kind of had a head for this real estate thing. The problem when I first started, is that the units that we had, the townhome units, were only about 40% occupied, and a lot of them were broken. So I had to fix them and then put tenants in them. And I realized very early on that we were not going to be able to sustain profitability for the longevity because we were in a very boutique market. So I went to my family and I said, I want to sell these units and I want to sell the sewer treatment plant because that's a really stinky business. And I want to build on the land. And my family wanted no part of that. So I ultimately ended up buying the company from my family. All right. I hired a contractor and I was going to come out of the ground and build on that land that I now owned. And I realized very, very quickly that he was going to bankrupt me before I even got out of the ground. So I fired him and I ended up starting my own construction company. And I knew nothing at all about construction. But I was bold, I was fearless at that point, and I asked a lot of questions. We grew very, very fast. We ended up with holding all of our construction licenses with the exception of HVAC and roofing. And the reason we didn't have those is because the liability insurance was extremely high. Within 3 years period of time, we grew to 36 employees. I was the largest private employer in that particular county. And I was making money hand over fist. Now, I will tell you, though, that while all of that sounds great, I was literally working myself into an early grave. It was 7 days a week, 18 hours a day plus. I was away from my family and friends. I did not have a support system. It was just work, 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 work. And the stress level was just enormous. Now, this is all building up to 2005, 2006. We came to 2005. Again, I was making money hand over fist. But I saw that we were not going to be able to sustain that kind of momentum and that kind of lending, those kind of lending practices for the course and for the duration. So I saw that there was going to be a crash happening. What I did not realize is that the crash was going to happen right on top of my head. I figured, well, Paige, you've got all these assets, you've got liquidity, you're only 10% encumbered. It's not going to happen to you. It's not going to hurt you. Boy, was I wrong. I was really wrong. When the crash happened, I did not realize that everybody owed me money. And when you're in construction, you're going to foot the bill for about 90 to 120 days. So all those people that owed me money could not pay me because their lending froze up. And when I'm running $25,000 a week payroll times 5 or 6 projects, the money really is out the door. So I had some decisions to make. I could have done what everybody else decided to do, which was file for bankruptcy. I chose not to do that. Instead, I liquidated everything I owned for pennies on the dollar, and I paid off all of my investors and everybody that I owed money to. All right. It took me about 3 years to do that. And I walked out of Arizona having lost $20 million. That's the very difficult learning experience that Monique just talked about. But I'll tell you, I would not change that for the world because it taught me who I am as an investor. It taught me who I am as a person. It taught me how I deal with money. It taught me my risk tolerances. So that experience, as difficult as it was, really propelled me to where I am now. And I would not trade that for anything in the world. So let's get into it. As Monique said, I deal in notes. I buy non-performing notes. So let's talk a little bit about what are notes. Notes really are a debt instrument. They're basically just a promise to pay. Now, when you're dealing with debt instruments, you're literally stepping into the shoes of the bank, which means, and now my things are not working here. There you go. Which means that you literally become your borrower's bank. And yes, you do become the bank. So what happens is instead of like a buy and hold situation where you own the property and you lease your property to a tenant, you're the landlord. If the air conditioning breaks in your property, as the landlord, you now need to pay to fix it, right? You have to send somebody out and you have to fix it. As the bank, if the air conditioning breaks, you do not have to pay for the AC repair guy to go out to that property because you don't own the property. You own the debt, meaning the mortgage or the deed of trust, depending if you're a judicial or non-judicial state. You buy the actual loan, you become the bank, and you are not on the hook to make any repairs. Now, your security, however, is that the house is secured and tied to that loan. So if your borrower doesn't pay, you can take the house, okay? I'm getting a little ahead of myself. So yes, you really become the bank, but you have no obligation to repairs of that house, which makes things wonderful. Now, there are different types of notes that you can buy. I buy non-performing notes that are secured by real estate, but there are other types of notes that you can buy. You can buy performing loans, which means that the borrower is consistently paying month after month. In a non-performing situation, the ones that I buy, the borrower has stopped paying. And I'm going to tell you the method to my madness in just a moment, right? So you can buy non-performing notes, you can buy performing notes, you can buy first position liens. I focus on first position loans, but you can also buy second position loans. You can buy third position loans. You can also buy auto loans. You can buy judgment loans. You can buy any type of note that exists, you can invest in it. You can buy credit card debt, right? Credit card debt is unsecured. In my opinion, buying those it's very risky business. That's why I focus on first position, being the first to get paid, first position, non-performing notes secured by real estate. You can buy notes on residential properties. You can buy notes on commercial properties. You can buy notes on land. You can buy notes on industrial buildings and warehouses. The world is your oyster. The world of notes is your oyster. So whatever your fancy is, you can buy a note that is secured by some form of real estate. All right. Now, I mentioned that I buy non-performing notes. Why on earth would I do that? That sounds counterintuitive. How do you make money buying non-performing notes? Well, I do so because I buy non-performing notes at a very large discount. And I'm going to give you some examples of that in a moment. But I buy based on the current market value of the securing collateral. So whatever the house is worth as it is right now, not what it's worth if I fix it, what it's worth right now at a discount, okay? So I'm using the collateral, the building, as the basis for my purchase price at a discounted rate. It does not matter how much money is owed on the loan. It just matters what is the securing collateral worth, and then I discount that from there. And I'm going to give you some examples of that, like I said, in just a moment. All right. So when I do that, I'm automatically building in equity, which mitigates my risk because I have a cushion of equity already when I first step into the note. Okay. Now, is there competition? I'm often asked this question, is there competition buying notes? Well, yes, like anything else, there's competition, in buying notes. However, I call it the gentler form of real estate and real estate investing. It's not like the courthouse steps where you're standing at an auction and people are bidding against you. It's not like a fix and flip property where you've got other investors that are overpaying for those houses, right? The one of many beautiful things that is involved in note investing is that you develop relationships with your asset managers. And I'll talk about that in a moment. And they literally send you the list of the assets that they have for sale directly to your inbox. You make your highest and best offer, and sometimes not always your highest and best. Sometimes you leave yourself a little wiggle room. But you make an offer to that asset manager and he'll tell you yes, no, or he'll counter your offer. That's it. So yes, there is competition, but it's very gentle form of competition. and the numbers speak for themselves. All right. So you're not panicking and trying to outbid somebody just to get a deal. It's a much gentler version of real estate investing. Okay. Now, how do I find deals? Everybody looks for two things, no matter what niche they're in real estate investing. Those two things are deals and money. Money and deals and money, right? The wonderful thing about notes is that I develop relationships with people. That's all I do. I do not send out yellow letters. I do not knock on doors. I don't cold call. I don't put up bandit signs. None of that. I spend $0 marketing for my deals. Where I spend my money is I go to conferences. I meet asset managers. I meet other note investors. I meet banks. I develop relationships. Real estate is all about relationships, everybody. This is a team sport, okay? So I develop relationships with asset managers and they send me their assets for sale for free. So if anybody ever tells you that you need to buy, it's called a tape, T-A-P-E. That's our note lingo. That's basically just an Excel spreadsheet that lists all the assets that the asset manager has for sale. There is no buying tapes in our space. You develop the relationship with somebody and they send it to you for free, which is wonderful, right? And as such, I literally can do this business anywhere in the world as long as I've got my computer and an internet connection, okay? And usually a cell phone, all right? Okay, so let's talk about exit strategies. And I'm going to give you some basic numbers here, everybody, okay? So quick disclaimer, these numbers can vary. I just want to kind of give you an example what I mean about buying on a discount of the current market value and what the difference is, all right? So again, because we're the bank, we're stepping into the shoes of the bank. So call me Mrs. Chase, all right? I am Mrs. Chase and my borrower owes a certain amount of money. A portion of that is called principal, right? The unpaid principal balance of the loan. So for easy numbers, because it's an afternoon in the evening here, actually not afternoon, it's the evening already. We're going to use $100,000, really simple numbers. So the unpaid principal balance is $100,000. Now I told you I buy non-performing notes and sometimes my borrowers have stopped paying for a period of time, okay? So they accrue interest, it's default interest and unpaid interest. We have a legal right to secure the collateral. So if the borrower doesn't live in the property, we can change locks, we can repair broken windows, anything that is not a rehab of the property. Those are all collectible expenses. We call them recoverable expenses. And that makes up the legal collectible balance of the loan. Okay, so this borrower in this example owes $100,000 in principal, but there's $20,000 in arrearage. All right, so they owe us $120,000. Now I told you I don't buy based on how much money is owed. Even though 120 is owed, the house is only worth $80,000. So this borrower is in the hole by $40,000. Okay. So I'm going to use the $80,000 as the basis for my purchase price, and I'm going to discount it from there. And for this example, because again, it's evening time, we're going to use 50%. It can vary. Some notes are less, some are more. But for this example, we're going to use 50%. So my note purchase price is going to be $40,000. I'm owed $120,000. But I'm buying this note that face value is $120,000 for $40,000. Now I've also got some workout costs, okay? Just like fixing and flipping properties where you have rehab costs, we have paper rehab costs, right? Where we have loss mitigation teams, insurance, possibly some taxes, et cetera, involved. So our workout costs for this example are going to be about $5,000. So my all into this note is $45,000. All right. I'm owed 120, but I'm into it for $45,000. I'm automatically building in a minimum cushion of equity at $35,000. So I've already got, the house is worth 80. I'm owed 120. I'm probably never going to see that because the house is only worth $80,000. And I'm discounting it from the $80,000. So our purchase price allows me to mitigate that risk and build in that $35,000 cushion of equity from the get-go, immediately from the get-go. All right. So exit strategies. In note investing, we use 4 main exit strategies. All right. However, we have 23 plus exit strategies available to us as note investors. The beauty part of that is that you can pivot depending upon what happens with market cycle. You can pivot and shift your exit strategy if you need to in order to remain profitable in your note, okay? In a fix and flip situation, if you're buying a fix and flip property, you're speculating, right? That property is going to be worth a certain dollar amount when you fix it. But markets change, as we all know, and especially in this market today, everybody, it's very volatile, right? It's up, it's down, it's up, it's down. The Fed can't figure out what they're doing. Well, they can. They're manipulating the interest rates, et cetera. So it's a very volatile market right now. And that can really affect your bottom line and your profitability. In a fix and flip situation, you really only have a couple different options, maybe, to exit that asset and make sure that you can cover your bases. In notes, again, we've got over 23 exit strategies available to us that will allow for us to pivot and remain profitable in our investment. All right. Now, we don't use all 23 all at the same time. We typically only use 4. They are these, okay? Foreclosure. Foreclosure is my least favorite of the 4 exit strategies. Now, across this country, we have judicial and we have non-judicial foreclosure states, all right? It's about 50-50. Judicial foreclosure states take a little bit longer period of time. When I first started note investing, most of them only took anywhere between 8 and 12 months. Now, because there's been such an influx of foreclosure starts across the country, especially in judicial foreclosure states, that time period is taken a little bit longer. All right. Now, there are certain states that I do not invest in because their foreclosure timelines are extraordinarily long, like New York. I don't tend to invest in New York because their foreclosure period is about 4 to 5 years. I don't want my money sitting stagnant for 4 to 5 years. So I avoid states like New York. Okay. But that doesn't mean that I don't buy in judicial states, because I do, judicial counties, judicial states, because I do. And I've had some really great success stories in judicial states. I'm going to show you a couple of case studies later on in this webinar. All right. So non-judicial foreclosure states typically take less time. And they are sought after. Most people, especially newer note investors, want to turn their capital quicker. So you invest in non-judicial foreclosure states. That timeline typically takes about 6 months, give or take. All right. Now, when you buy a note, and if your foreclosure is your exit strategy, and sometimes you have no choice. Sometimes you have to go with a foreclosure route. Okay. And unfortunately, I don't have time to talk about why you would do that tonight. But sometimes you have to go through a foreclosure auction. All right. And if that's the case, then you have, oftentimes you're either going to sell that asset at the foreclosure auction. Okay. Now there's always, in a foreclosure, there's always an auction. It just depends. If it's a judicial state, the sheriff is going to conduct the auction. If it's a non-judicial foreclosure state, then the trustee is going to conduct the auction, but there's always an auction, and you as the bank get to set that opening bid. So you control how much money you want to end up with, in essence. Like, what's your bare bones minimum? All right, you get to set that first opening bid. You can't bid again, but you get to set that opening bid. So in our example, as you can see the numbers to the right, in our example, we expected that the house for this property, for this note, was worth $80,000. But let's say we discovered that there was some kind of deferred maintenance and we don't really want to end up with this property as an REO in our portfolio. We can set that opening bid lower. So in this, for instance, let's say we're in a non-judicial foreclosure state. So we're looking at maybe a 6-month timeline, and we set the opening bid at $70,000 and it sells at auction to a third-party buyer. Well, within a 6-month period of time, you've now made $25,000 for basically flipping paper. That's it, right? They get the house, you get the check. Now, the beauty part about note investing is if you're a fix and flipper and you want the house, you can set that opening bid. Remember, you're owed $120,000. If you want that house, you can set, as the bank, you can set that opening bid at $120,000. You cannot set the opening bid at $120,001 because you're not owed that extra cent. But you can set the opening bid to as high as you are owed, the legal collectible balance. Very likely, if you do that, nobody's going to bid at auction, and that property will then revert back to you as an REO, and you can do with it what you want. You can fix and flip it. You can make it a buy and hold. You can sell it or lease it as a short-term rental, whatever you want to do, right? You can turn around and hold the paper and sell it to a fix and flipper and be their bank. There's so many different things you could do. All right. I'm going I'm going off on a tangent. So our next exit strategy that we mainly use is also a short sale. That's pretty self-explanatory, right? Generally, short sales take about 3 to 6 month period of time. Most people know what a short sale is. I'm owed $120,000. I can choose to work with my borrower and my realtor to sell that property for $80,000. That's a short sale. I'm shorting the amount of money that I am owed. I'm willing to take a $40,000 discount in order to sell that property. Again, pretty self-explanatory. So we can sell it for $80,000. Now keep in mind that beauty is in the eye of the beholder. I have often had people that the realtor has been in contact with the neighbors, and they have family members on that same street. They're willing to pay a little above what the current market value is for that property to secure it for a family member. I've many times had people pay over what the current market value is because they want their family member to live on that same street, right? So again, you can sell it for $70,000, $80,000, sometimes even above what the current market value is in a short sale, and you're still coming out ahead. I mean, we're talking about a 3 to 6 month turn. If you sold this property to somebody for $90,000 and you're into it for 45, you've doubled your money in 3 to 6 months, right? Because you're into this note for $45,000. And all you didn't pick up a hammer, you didn't fix and flip anything but the paper, okay? The next one is called a deed in lieu of foreclosure. A deed in lieu of foreclosure is also a shorter time frame. It's 3 to 6 months. What that means is we work with that borrower. The borrower comes to us and says, you know what, Mrs. Chase, I'm in way over my head on this house, and I don't want any part of it, but I don't want a foreclosure on my credit. Will you take this property back as payment in full? So now you're taking actual possession of the house, okay? Once you take possession of the house, then you can do with it again what you want, because it's now REO. It's now real estate owned by you in your portfolio. You agree to take that property back as payment in full, and now your loan is wiped out. Now, there are some pitfalls to that. You want to make sure that there are no junior liens behind you. But Again, that's all part of due diligence that I talk about in the workshop and teach people what to look for and how to avoid those particular pitfalls. But it's a very quick and easy way to take that property back as long as your borrower is willing. Okay. Now, you don't have to do a deed in lieu of foreclosure. You, as the bank, have the option of any of these different exit strategies, but your borrower does need to participate in most of them. All right. Especially the short sale and the deed in lieu. Now, the third, and one more thing, again, if you take that property back, you've built in your equity, right? You've got your cushion of equity of $35,000. You can fix and flip this property, short-term rental, buy and hold, sell it to another investor and carry the paper for them and become their bank. So many different options for you that are available to you. All right. Okay. My favorite is called the reperforming scenario. Now, most of you know this as a loan modification. Okay. This is where the bank works with the borrower. And this is my favorite because I love to help people and make money doing it. All right. And I'm going to show you some examples, real dollars from my portfolio in a little bit of how we make this happen. All right. Generally, this is a little longer term play, meaning it's 6 to 12 months, sometimes longer. You'll see that when we get to my case studies. 6 to 12 months, typically in a reperforming situation. And we start out with what's called a trial payment plan. All right. In a trial payment plan, we want to make sure, because the borrower has not been performing up to this point. So we want to make sure that they actually do what they say they're going to do. We're going to give them a second chance, but they have to prove themselves first. Okay. So I personally never go directly into a loan modification. I put a trial payment plan in place first for up to 6 months. And once they prove themselves, then we convert it to a permanent loan modification. All right. So as the bank, remember I'm Mrs. Chase, as the bank, there's all kinds of things I can do with a loan modification. I can forgive some debt, right? Again, beauty is in the eye of the beholder. If your borrower wants to stay, they don't care how much their property is worth. If you are willing as the bank to forgive $20,000, because you're never going to see it anyway in the other exit strategies. If the current market value is only $80,000, if you want to sell that property at auction, you're going to have to probably go down to about $80,000, right? So if you're working with your borrower, if you can incentivize them to do well by reducing that debt by $20,000, right? And you don't do it automatically. You make them prove themselves. So, okay, the first 3 to 6 months, or the first 3 months, if you pay on time every time, I'm going to wipe out $10,000. And then the next 3 months of your trial payment plan, if you do well in that second 3 months, then I'm going to wipe out the other $20,000. We've now modified the loan down to something that's palpable and doable for your borrower. We can reduce interest rates. We can extend the term of the loan. We can reduce principal and defer some principal. You're going to see one of those in an example in one of my case studies here shortly, right? So there's all different kinds of things that you can do. Now, why would you do this? I personally don't want houses back. I want the security of the house as the collateral for my invested dollars, but I don't want the responsibility of the house. Okay. I would much rather my borrowers take that responsibility. Not to mention the fact that I love to help people get back on their feet because I've had life happen to me. I lost 20 million in the crash, and I know what that feels like. So my goal is to go into each and every note to try and help people stay in their homes. And I get to create chunks of cash and streams of monthly cash flow in this same vehicle by doing that, which is a win-win-win for everybody, as far as I'm concerned. All right. So again, chunks of cash and streams of monthly cash flow in this same investment vehicle. You as the bank get to decide, right? You are in control at all points in this investment cycle. And the other beautiful thing is that you're not reliant on others for your profitability. Okay. Now, again, I don't have a lot of time to explain that. I think you're going to see a lot of that in the case studies, but trust me when I tell you this type of investing is what I call very front end loaded. That means that the bulk of your time is going to be spent in the beginning before you even buy the note. So when you're doing your due diligence, that's the bulk of your time. That's where it's going to be spent. So how important is due diligence? It's extremely important. And there are many steps that I go through in the workshop about due diligence to protect you against any pitfalls that may occur in note investing. And there are some, I'm not going to lie to you, everybody. There are some pitfalls that you need to be aware of. You don't want to just willy-nilly fake it till you make it and go out there and buy a note and pray. No, there are certain steps that you want to make sure to take during your due diligence to make sure that you have that security is in place for you and your invested dollars. Typically, I always like to say, if there's something that seems amiss, you're probably right, okay? So good due diligence is key to your success in this investment strategy. Now, that being said, because we have 23 different exit strategies, there are ways that you can combat an oops. And everybody makes an oops, right? We've all skinned our knees. I've still had a couple of oopses, even fairly recently in my portfolio. But the beautiful thing is that there are steps that I can take and ways to pivot to take away and erase that oops, okay? I like to say that good due diligence, though, will give you virtually risk-free note investing, okay? There is no such thing as a bad note, in my opinion, but there is such a thing as buying a note badly. So know the steps to take. But that is where the bulk of your time is going to be spent before you buy the note. Once you buy the note, you are now going to hand it off to your team of licensed debt collectors, and they are the ones that are going to be talking with your borrower. They are the ones that are going to handle all of the communication, all of the documentation, and cover your assets, right? They are the ones. And then you manage the managers. So the bulk of your time in any given investment in the note space is fairly minimal. And you'll see some examples of that shortly. Okay. So that being said, who wants to see some case studies? And by the way, if you have questions, everybody, I don't have chat up, but please put them there and we'll get to them at the end. All right. I should have said that a little while ago. All right. So case study number one, these are all from my actual portfolios, okay? This one is a duplex in Casa Grande, Arizona. Both of the units had been rented, but we didn't know the tenants. We didn't know the names of the tenants. We didn't know anything about the tenants. We just knew that the duplex was occupied on both units. The current market value of the securing collateral, the duplex, was $120,000 to $125,000 on this one. All in for this note was $64,500. So that was between purchase price and my workout costs, okay? The property, again, was occupied by unknown persons. We didn't know who was living there. We ended up foreclosing on this note in Arizona, and we were actually really surprised that it came back to us as an REO. Nobody bid on it. We actually, believe it or not, we had somebody contact our trustee and say, I was on the way to the auction and I broke down. Would you be willing to sell it to us? And I'll tell you why we didn't in a moment. So it did actually work out to our favor that it didn't sell at auction, because we had placed the auction starting bid. Remember, I'm the bank. We started the bid at $109,000. All right. So foreclosed on the note. It came back to us as REO, and our loss mitigation team suggested to us that we evict the people that were living there. I didn't want to do that. So what we did is we sent out a door knock service. They knocked on the door. We were able to talk to both families. They had lived there for many years. We got the name of the property manager. We contacted the property manager and we asked them, hey, do you have any rent that's being held? They did. So we were able to collect that rent. Okay. So we have a little chunk of cash. Then we wanted to sell this property so we could recapture our capital. And we asked the property manager, hey, do you have any investors that be interested in buying this property? And she said, we do. We ended up selling this property 21 days later to this property manager's investor for $120,000 in cash. We paid her a 3% commission. That would have been, instead of listing it, we just paid her what her half would have been, right? We ended up, after closing costs, our profit was about $54,000, $54,500, which is about a 54% return on transaction. Our JV partner in this deal, in this asset, his portion was 27%. Okay. Who likes to invest in real estate the way I invest in real estate? Right? Next. Whoops. I went too fast. Next. This is a gorgeous Victorian. And by the way, as a reformed rehabber, everybody, what I call myself, I love the old Victorian homes. Don't fall in love with the houses. Really don't. Fall in love with the numbers. But I can't help it. I have a soft spot when it comes to these beautiful old Victorian homes. All right. So gorgeous 100-plus-year-old Victorian home. It was in Richmond, Virginia, non-judicial foreclosure state. Squatters had done some minor damage. The current market value of this property was $125,000. Now, as a reformed rehabber, I just had to know. So I did the ARV, the after repair value, and discovered it was $225,000. All right. Now, all in for this note was $54,200. The borrower was deceased, and the heirs did not want anything to do with a deed in lieu of foreclosure, because we wanted this. We actually wanted this property because we knew that we were going to be able to sell it for quite a bit. But they didn't want to give us a deed in lieu of foreclosure. Now, one of the things is that if you looked at this property just on Google Maps, which a lot of investors do, you would have seen across the street a car on blocks that was graffitied. Okay. So on Google Map, or Google Earth, rather, I said Google Maps, on Google Earth, this area looked really sketchy, right? But because we contacted a realtor and asked some questions and had boots on the ground and had them go by, we discovered that this area was in the process of gentrification. Okay. Which is a big plus. Across the street was a brand new rehab. Next door, and this property were all this whole block was zoned R3, which means that it had multifamily potential. So somebody could have torn this house down and built an apartment complex, or apartment building, not a complex, but a building, and could have rented out those apartments. I'm glad that didn't happen, but they could have, because of the zoning, right? So it makes it very, very sought after area. Again, I said the squatters had done some minor damage. This house had been updated, but there was some minor damage. We took this house to foreclosure auction. Now, we were owed $217,000. That's how much was the legal collectible balance. We were owed $217,000. But remember, I said the current market value of the securing collateral of this house was only $125,000. Okay. Now, I knew we were going to get every bit of that. But I could have, if I really wanted this house, I could have taken it to foreclosure auction and set the bid at opening bid at $217,000. All right. I chose not to do that. I set the opening bid at $116,828. Never set an opening bid at a round number. It's a mental thing. I can't explain it. I actually had an asset manager tell me that once, and it always stuck with me. So we set the opening bid at $116,828. It sounds like a very specific amount of money that I am owed, correct? And we did that because we were in the hopes of creating a bidding war, which is exactly what happened. We knew the house was worth 125 as it sat. We had a bidding war. Sure enough, we ended up selling it for a little over $124,000. Our net profit was $70,000. That's 129% return on transaction. 129% return on transaction in less than a year, everybody. Our JV partner, his portion was 65%. Who likes to invest in real estate the way I invest in real estate, right? Now, because I am a reformed rehabber, I wanted to follow up with this property and see what happened because I knew a rehabber bought it. Sure enough, that top picture was from our realtor. The bottom picture was from the Zillow listing 4 months later. Sure enough, they sold that rehabbed property for $230,000. Now, if you are a fix and flipper, you can use note investing to acquire properties this way. You would have purchased this property for $54,200, probably put close to, let's call it, I hate that 20, it's always $25,000 on every television show you watch, right? So probably updating it with kitchen and a few other things, probably $50,000, $60,000, right? So you would have been into it just over $100,000 and you would have sold it for $230,000 in less than a year's period of time, probably even less than that. Okay, so there's a very powerful way to invest in notes, especially if you're looking for property. Now, I will encourage my students, if this is your play, if you are a fix and flipper and you want to acquire property via notes, please do that all day long, but please look for houses that are unoccupied. Because I can tell you firsthand, it really sucks kicking families out of their house. It's not a fun process. I've done it because I have to. I'm a business, not a charity, right? It's not fun kicking people out of their house. So if your play is that you want the property, please go after properties that are vacant, okay? If they're, especially if they're houses. Okay, this is a fun one. This property is Chicago, Illinois. I usually avoid Chicago, Illinois, because of the foreclosure timelines. However, I had a feeling about this one, and my due diligence proved that I was going to be successful with this particular property. All right. So I bought the note. Now, we ended up modifying this loan. We were owed just shy of $200,000. So $197,877 is what we were owed. The current market value of this property was $255,000, meaning this borrower could have sold this house and paid us off in full and gone on her merry way. She didn't want any part of that. She wanted to stay in her home. Okay. So in lieu of giving up the farm, we needed to come up with a compromise to be able to make her payment manageable without giving up some of that principal. We gave up a little bit, but not all of it, because she could have paid us off in full if she sold her house. All right. So we did what we called a modified unpaid principal balance with a deferred principal. Okay. Which basically means that she's not going to pay interest on the deferred portion of the money. That levels the playing field for your monthly principal and interest payment, your monthly mortgage payment. But we're not giving it up in the event that she does ultimately sell the house. Okay. So let's look at this. All in for this non-performing note when we bought it was $90,013, and we bought it in late 2017. The property was occupied by the borrower. Now, initially, the borrower did what I call an ostrich, right? She stuck her head in the sand and was hoping it was going to go away and was uncommunicative. So we had to start off the foreclosure to get the borrower communicating with us. When we started the foreclosure, she immediately filed bankruptcy 13. So she went to court, she filed for bankruptcy because she chose bankruptcy 13 because she wanted to keep the house. In bankruptcy chapter 7, that means they want to be absolved of the debt. In bankruptcy chapter 13, as a note investor, especially one that wants to cash flow, I do the happy dance, right? Because in bankruptcy 13, that means that she is going to work hand in hand with a federally appointed trustee through the court system to pay me every single month. Okay. So she filed her bankruptcy chapter 13. We filed what we call our proof of claim. That's what the POC stands for, right? So we filed our proof of claim, and the borrower started paying $636.22 a month in her P&I payments starting early 2018. The reason for that is because when she filed the bankruptcy, we said to them, okay, we'll incentivize her. We didn't have to do this, by the way. We just chose to do it. We'll incentivize her. We're going to forgive some of the debt. Remember, she owed us $197, almost $198. We brought the UPB down, the unpaid principal balance, which is the interest earning portion, down to $132,000, but we deferred $34,000. So that $34,000 is kind of the cherry on the sundae, right? She's not paying interest on it, but it's still due at the back end of the loan. Okay. So she paid her $636.22 a month P&I in early 2018. Plus, when you file for bankruptcy chapter 13, everybody, whatever the arrearage portion is, you have to pay that back on top of your monthly P&I payment. So her arrearage portion, the portion that we did not forgive, she ended up paying, and it was $31,877. She ended up paying on top of the $636.22 per month. She paid $531.28 a month on top of that. So we were in essence earning about $1,150 a month. Okay. And the bankruptcy court, the federally governed bankruptcy court, monitored this whole process. I didn't have to do anything except go to the mailbox and pick up the check. And in all actuality, they sent it to the servicing company and it just got direct deposited into my bank account. Okay. So we kept this note because I wanted to cash flow it. And we kept it for 5 years. I ended up selling this note in February of this year. That borrower, I will tell you, in 5 years, never missed a payment, always on time. So we cash flowed it for 5 years. And by the time it was all said and done, we really only reduced the unpaid principal balance by about $2,000. So she owed $130 at that point. Okay. Most of her $636 interest payment was interest. Interest to us, everybody, is pure profit. That's all it is. It's like rent without the obligation. So $600 a month approximately was interest, plus $531 a month, basically interest, right? That was all pure profit that I was earning. So we netted about $36,000 there on top of the $31,877. I sold this note for over the unpaid principal balance. We sold the note for $164,172. That's over the $132,000 that's owed in the UPB. The reason for that, everybody, is because the current market value of the securing collateral was really high and the area kept going up, right? So if she defaulted, they knew they were going to see their money regardless. So they paid me $164,000 plus, which was over the unpaid principal balance. All right, that's a ton. And they wanted a performing loan. I sold it to a performing note buyer. So the net on the note sale, just the note portion, was $52,000. If you add all of that together, $52,000 net on the note, $36,000 in interest from the monthly P&I payments, plus the $31,877 she paid over the course of the bankruptcy in arrearage, that's $119,877, which is 133% return on transaction, which if you average over the 5 years is 26.6% average return on investment year over year. Okay. I do this all day long. The borrower gets to keep their house. I get to not only create chunks of cash, but streams of monthly cash flow, right? Now, I will tell you that I worked on this note over the course of the 5 years, maybe 20 hours, maybe. And most of that was spent during the due diligence and coming up with the, the bankruptcy paperwork, working with the loss mitigation team attorney to get the correct proof of claim into the bankruptcy court. 20 hours. That was about my time commitment on this note, right? Who likes to invest in real estate the way I do it. This is why I do what I do. And I get to keep people in their homes instead of kicking them out. All right, last case study. This one was great. This is one of my favorites. The family sent our loss mitigation team a thank you letter, and it was just so warming and heartfelt. And this is just one of those that I will always carry in my heart with me. This was an owner-occupied single-family residence in Richmond, Kentucky. The borrowers had stopped paying, and you'll see why in a moment, but they literally had been squatting in their house for many years. So their last paid to date, so the last time that they paid on time was April of 2012, okay? April of 2012, keep that in mind. All in for this note for us was $49,252. We acquired it in September of 18. So they literally have been squatting in their house for 6 years. They were just waiting for somebody to kick them out, okay? Again, the owner was occupying this property. They had been there since 1998. So I knew in my investment strategy, I knew this borrower was going, if we could come up with the right numbers, I was going to be successful in getting them to reperform. All right. So the owner was living in this house since 1998. That's where good due diligence comes in, everybody. You actually get to know that note and that borrower and kind of can predict what the outcome and the exit strategy is going to be simply by doing good due diligence. All right. And I teach you that in the workshop. All right. Legal collectible balance for this asset was $95,143. Their original interest rate was really high, 10.99%. The reason that they stopped paying is that the husband had a medical emergency. He had a condition and he couldn't work for 3 years. Okay. They were just doing everything they could to make ends meet, much less pay their mortgage payment. So our loss mitigation team contacted these borrowers, and of course they wanted to stay in their home. So remember when I talked about reperforming loans, I don't immediately start out with a loan modification. I start out with a trial payment plan that converts to a loan modification. So in March of 2019, it took us a little time to get this all squared away, about 6 months. We put the trial payment plan in place. And we put it in place for 6 months. Now we required that they come up with $1,000 fee. It was what we called a reinstatement fee. So we created a small chunk of cash. All right. That was to have a little skin in the game because they hadn't paid for years. Now the borrower paid their $1,000, was very successful in their TPP payments. This was, again, a trial payment plan. Now, the beauty part about a trial payment plan is that the money that you generate does not apply to the new note terms. So if you're reducing or forgiving debt, that money is when the new terms are set in place. But during the trial, it's still on the old loan. Okay, so it's basically kind of free money, everybody. So we had them paying $708 a month for the trial payment plan, which generated $4,248 in that 6-month time period. That's, again, free money because it didn't apply to the new terms. It applied to the old loan where we forgave some debt, right? Then the trial payment plan converted to a permanent loan modification on October 1st of 2019. Now, again, I wanted cash flow. I am the cash flow chick after all. So I wanted the cash flow. We ended up rolling the arrearage, meaning we forgave some debt and we rolled some of the arrearage into the new loan, the new terms. We reduced the principal, even though we left some equity on the table, right? Because this house was worth a little more than the borrower actually owed. So we put a new loan in place permanently as of October 1st of 2019 at $87,500 at an 8% interest rate. So we almost knocked off three interest rate points, which is huge. And then we made the loan for 480 months. Now, most loans are 360 months, okay? We did 480, which is a 40-year loan because the borrower, it made the payment more manageable for the borrower. Okay. And that's better for us because we earn more interest, and the unpaid principal balance. If you've ever looked at an amortization schedule, and if you haven't, I strongly urge you to do that. You will see that it takes, before in your monthly principal and interest payment in a 30-year mortgage, it takes 17 years before the bulk of your payment goes toward principal. In the first 5 years, the bulk of your payment goes toward interest. In the first 5 years, it's almost your whole payment is nothing but interest. Interest to a note investor, everybody, is pure profit. Okay. So we rolled, we reduced, we forgave, we gave them a new interest rate. We extended the term of the loan to make the P&I payment more palatable. You add all of that stuff together, and that $1,000 up front for the deposit, the reinstatement fee, $4,248 plus $608.40 a month. We reduced that after the trial payment plan. We reduced the payment by $100 a month. Okay. And we wanted it for cash flow. So interest for the first 60 months of that $608 payment, $580 of it every month was interest, times 3.5 years, because remember, it took us about 6 months to put it in place. Then we did the 6-month trial payment plan. Then we converted it. So the permanent loan at the $580 a month in interest, only the interest portion for that 3.5 years that we cash flowed it was $23,780. Borrower gets to keep their house. Adding the things all together, we're going to do that in a moment, because I sold this note with the other note, with the Chicago note in February of this year. So let's add it all up. Looks like this. Sold the note in February of 2023 for $82,500. It's a slight discount off of the UPB. The UPB at the time was $86,000 and change. Remember, they had only reduced that UPB by a very nominal amount. It was like $30 a month. That was it. That was going toward the principal portion of the loan. The net on this note sale was $34,850. If you add all of the stuff up, $1,000 deposit, $4,248 in the cash flow for the trial payment plan, plus the $23,780 net interest profit for that 3.5 year period following the trial payment plan, plus the net on the note sale, all of that equals $63,878, which is approximately 130% return on transaction, which averages an ROI of per year of 28.8%. Okay. Again, total amount of hours that I worked on this note, it was a little more active because coming up with the options for the loss mitigation to work with the borrower for the trial payment plan, et cetera. So I had a little more time dedication, but all in all, about 4.5 years I maybe put in about 30 hours worth of work, maybe, for 130% return on transaction, or almost 30% per year return on investment. Who wants to invest in notes or invest in real estate the way I do it? Right? Borrower gets to keep their house. They're happy. We got to create chunks of cash and streams of monthly cash flow. We did not pick up a hammer. We did not have to do any of that stuff. All we did was help people stay in their home and in essence, flip the paper, right? Okay, so you've heard Monique talk about my workshop. You've heard me refer to it during this presentation as well. This is on demand. I used to do this live and in person. It was a 3-day workshop, and your brain hurt. Monique sat through it and she took it and her brain hurt, but she enjoyed it, thankfully. But I have now transferred it to an on-demand platform. Okay, so this is an online training. It's all the same stuff, and I give you all the tools. I give you my team. I give you a workbook. You have, obviously, it's on demand, so there's videos and modules and homework, right? There's a resource list, so you have all of my team. And then I give you bonuses as well. So you have everything you're going to need to know, including a couple of asset managers, which is where to buy notes. Okay, so I give you all of that in the on-demand training. It is online. So if you go to cashflowchick.com/goddess, you can sign up for that on-demand training and take it at your leisure. Okay, you can take it in bite-sized pieces, so you are not overwhelmed. But understand, there's a ton of information. I do not leave anything out. I'm the type of person that if I'm going to teach somebody how to do something, I'm going to give you all the tools to be successful. All right. Now, I will tell you that normally in the live portion, I used to actually charge $697 for the live portion. Then I went on, and on demand, it's $597. Okay. So if you were just going to sign up, it would be $597. But Monique twisted my arm. And I don't give this discount to anybody, I will tell you. So it's $150 off. She wanted an extra special something for the goddesses. So you can do this at your leisure at $150 off. So it's $447 for the Building Wealth with Notes on-demand workshop, right? Go to cashflowchick.com/goddess, and you will grab your on-demand training. You can get started immediately. And again, this discount is exclusive to you as the goddesses. If you just want some free stuff, happy to send that to you as well. Go to cashflowchick.com/free or /info. If you want to book a call with me, feel free to do so. You can go to my website, Cashflow You can reach out to me via all of the different social media platforms. My email address is info@cashflowchick.com. And of course, Cashflow Chick is everywhere on LinkedIn and Facebook, YouTube, etc., Twitter, etc. So that's all I have.
I put the link in the chat. So I've taken this workshop, this training. Paige is not kidding. She gives you everything you need to get started to do this, from like the conversations you need to have with different people, like exactly the scripts you need.
Yep.
It's really valuable. I've been a passive notes investor since 2016. I love my notes investing, and I think if you're at all attracted, then definitely check it out. And we have some time if you have questions. Any questions for Paige about anything she's talked about, she's shared. I did have one question, and then if you have questions, put them in the chat, or you can use the Q&A function. But one of the questions that I had for you, Paige, is with the interest rates rising, how has that affected the notes business right now? How's that affect?
So it's actually been a very interesting time. I often talked about the storm that was coming when COVID first hit. And the government really kind of kicked the can down the road quite a bit. They continued with their quantitative easing, right? So they were printing money all the time. They kept the interest rates really low, which kept people buying and refinancing, which also created a shortage. And so housing prices kept going up, 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 up. And as such, there was some volatility and not as much product that was coming into the market in notes. I mean, there's always going to be the things that happen to people, right? Death, divorce, medical conditions, where people have to sell their home or they get into financial distress. There's always that. In terms of the interest rates rising, it's starting when interest rates rise, less people qualify and it brings housing prices down. So where people may have had equity in their home 2 years ago, they don't have that same equity now, okay? And when one of those life events happen, downsizing, there's been a tremendous amount of job loss that we've been monitoring that is not being reported in the news, you guys. It is not being reported in the news, but people are losing their jobs. Foreclosure filings have been in the last, starting in 2023, have been upwards of over 300% increase since the previous year, right? So what that means is that when interest rates rise, the values in houses go down, which creates, that you want to be careful as a note investor. This is one of the things that we want to make sure that we're not overinflating the current market value of the securing collateral, right? And we have to account for home prices coming down. So what we've been doing as note investors is we've been taking the current market value of the securing collateral right now as it sits and discounting it by it depends on the market. You kind of have to really talk with realtors about this, but we'll discount that by, anywhere between 15 and 22%. Okay. As the basis,
yeah,
as the basis for the discount to allow for that reduction that's coming down. Now, let me say this though, even if we did an oops, right? Even if we bought it based on the current market value it sits right now and it drops 20%, everybody, we're still going to be okay because we've already built in that cushion of equity. Remember from our example, we had $35,000. So worst case scenario, we're not going to get above and beyond what we expected to get, even if it drops to the minimum of 80,000, right? Or if it drops to 70,000 or 60,000. Historically, not even in the crash of 2007, 2008, historically within a 6-month period of time, pricing has not dropped beyond like 30%. It's never dropped 50%. So you're still going to be okay. And that's where the extra exit strategies come in, that if the market drops beyond all history and you have to pivot, you can. Okay. So the rising interest rates are actually helping us as note investors. We just need to be careful in terms of our pricing.
And then you just buy things at a higher discount.
Yeah, you just buy things at a higher discount. And the more that's coming into the market, and we're seeing more and more and more of it. I know I sound like a broken record, even to my own ears. I've been saying that for a couple of years now, only because the government has done things again that have kind of kicked the can down the road to elevate the pending doom that was happening, because we had huge upswings in people that were defaulting on their mortgages. So they've done things to kind of stall that off, but between the bank failures that we saw, in recent months, and the foreclosure filings, and then the high interest rates and inflation, we're kind of at that perfect storm that we're really starting to see more and more product coming into market. All of us in our space are really saying that probably the very end of this year and the beginning of next year is really when we're going to start to see those tidal waves. And we think that we're probably going to have anywhere between a 2.5 to 5 year run at the really decreased values. Mm-hmm. I can't guarantee that, obviously, but that's what kind of history has taught us.
Yeah. I have another question that I often get asked about this. So how much money do you need to get started in notes, all right? And that,
Yeah.
so that's a question you hear a lot too.
Yeah, and let me stop sharing this so we can actually talk. So the answer is it depends. There are notes that you don't necessarily, the one downfall, if I had to pick a downfall of note investing, is that yes, you do need cash. Unless you're $100 million plus note buyer, which I'm not $100 million plus note buyer, there's no financing for notes. Okay. However, that being said,
Or the bank. So,
I wish I was that kind, but no. Actually, I'm not sure I do, because that's a whole heck of a lot of work, right? So there's no financing for notes. However, it's a perfect vehicle for self-directed IRAs, right? So, and there's so much money out there. People have been just stalled out, and really you just need to, like any kind of note, any kind of real estate investing. You just have to open your mouth and talk to the people you know, and network and talk to people, because there is so much money out there. I actually had a mentor student tell me the other day, it was kind of funny, because when she first started, she was like, Paige, I was originally really worried about the money and what was I going to do? And she said, now I have more money than I know what to do with. And she said, I can't believe those words are actually coming out of my mouth, but I do. And I said, well, that's a great place to be. So, so that
you gave many examples where you said, I have a joint venture partner and they made this and they made that. So there are
exactly.
people that can, if you put up the money, there's other people that have money that would love you to use the money to make money.
Yeah. And there are notes that you can buy out there. I actually have another student that actually bought, I cannot believe this. I told her if she didn't want it, I would buy it. That she negotiated with somebody who just was closing down their portfolio, and it's a performing note. She's owed, I think it's upwards of like $80,000, and she bought the note, performing note, and we both reviewed the collateral file together. There was nothing wrong with the collateral file. Consistent. She bought it for $5,000. $5,000. So there are notes out there, and there are some notes that are non-performing that are $5,000, $10,000. Keep in mind, you're not going to be in A+ neighborhoods, right? You're going to be in some sketchier neighborhoods. So keep that in mind. But there are notes that are really low, and then there are notes that are really high. I've had asset managers that want that there was a title defect with the note, and they just gave it to me. Here, because I was buying something else. They just wanted it off their books. And I've had some great success with those notes. So it's really just a matter of just developing who you are as a note investor. I talk about that a lot, in the workshop, what your risk tolerances are, and who you're willing to talk to.
Wonderful.
Yeah.
Okay. I'm not seeing any other questions in the chat. So thank you. Thank you so much, Paige. That was amazing, as
Absolutely.
always. Y'all go to cashflowchick.com/goddess if you to get that workshop for the $150 goddess price. And you'll
Goddess discount. It's $447.
Sorry. $150 goddess discount. And you won't regret it. This is, if you're at all interested in it, this is the way to, Paige is the best teacher that I have found out there. So
thank you.
Thank you. And thank you, goddesses, for being here. Well, we'll send out this recording, and definitely this is a wonderful opportunity. So thank you.
Thanks, everyone. Thanks, Monique. As you know, I love you. I love the goddesses.
All right. Bye, sisters.
Bye.